Close your eyes. Picture the world as it stood in early 2013. The global financial crisis from 2008 still cast long shadows. Trust in traditional banking crumbled, leaving voids filled with doubt and skepticism. Amid this uncertainty, a revolutionary idea began to gather momentum: Bitcoin. Bitcoin was not just another currency. It was a digital enigma, decentralized and beyond the reach of central banks and governments. Launched in 2009, its creator, the mysterious Satoshi Nakamoto, remained unknown. Nakamoto's white paper detailed a radical vision: an electronic cash system, peer-to-peer, secure, and independent of trusted third parties. By 2013, Bitcoin's journey from obscurity to the fringes of mainstream awareness had begun. Enthusiasts, technologists, and libertarians formed a passionate community. They believed in Bitcoin's potential to transform global finance. In online forums, they shared knowledge and dreams of a decentralized future. The price movements of Bitcoin that year mirrored the enthusiasm of its adoption. In January, it hovered at $13, while whispers of its potential spread like wildfire. By October, Bitcoin's value surged past $100, then doubled. Each rise sparked speculation, excitement, and disbelief. It wasn't just about profit. It promised liberation from traditional finance. On November 29, 2013, Bitcoin reached $1,242. It surpassed gold's value for the first time. This milestone captured imaginations, turning skeptics into believers and igniting global conversation. Yet shadows loomed over this triumph. The forces that fueled Bitcoin's ascent also threatened its stability. A fragile dance of optimism and caution unfolded. The peak was short-lived, followed by a swift, steep descent, a reminder of the risks in uncharted territories. As Bitcoin soared, the global landscape shifted. The Chinese government banned its banks from using Bitcoin. This decision sent shockwaves through the market, highlighting the precarious nature of this digital frontier. Within days, Bitcoin's value plummeted by 60%. Traders and investors panicked. Speculative trading, market volatility, and unpredictable regulatory actions fueled the chaos. For over a year, Bitcoin's price lingered below $500. It was a sobering period for those who dreamed of limitless gains. Many investors from 2013 faced harsh losses, their dreams of digital riches dashed. Yet Bitcoin's story in 2013 is not just about financial gain or loss. It's a testament to the resilience of an idea that captivated digital pioneers despite setbacks. After the crash, discussions on regulation and oversight intensified. Governments and financial institutions grappled with the implications of a currency beyond their control. Within the Bitcoin community, debates raged on the path forward. Lessons from 2013 resonate today. They offer insights into human nature and the allure of financial risk. That year left a lasting impact on the cryptocurrency landscape, shaping its evolution and future. Bitcoin, once a digital curiosity, became a symbol of promise and peril. Its journey reflects a broader story of innovation, speculation, and the eternal quest for something beyond the ordinary. As we delve deeper into this episode, we'll explore the intricate dance of hope, despair, triumph, and challenge that defined Bitcoin's tumultuous rise and fall. Each chapter will unfold like a page from a thrilling saga, a story of ambition, ingenuity, and the relentless pursuit of a new kind of freedom. In this quiet stillness, let 2013's lessons linger. The echoes of Bitcoin's tumultuous year remind us of the fragile balance between vision and reality in the ever-evolving world of digital finance. In 2009, amidst the shadow of a global financial crisis, an idea emerged that would challenge the very foundation of financial systems. An unknown figure, using the pseudonym Satoshi Nakamoto, Community that was still defining its identity and purpose. Bitcoin stood at the cusp of mainstream recognition and adoption. It was a period of transformation, where the cryptocurrency was both lionized as a liberating force and criticized as a speculative bubble waiting to burst. The year 2013 would prove pivotal, a crossroads that would test Bitcoin's resilience and reveal the fragility inherent in rapid growth. In this moment, the groundwork laid in previous years converged with the unfolding events of the present. As we navigate through the early days of Bitcoin and its gradual ascent, we witness not just the evolution of a currency, but the forging of a new cultural and economic paradigm. The story of Bitcoin's beginning is not just about technology. It is about people, visionaries, skeptics, and everyday users who saw in this digital currency a chance to reshape the world as they knew it. Their stories, marked by triumphs and setbacks, would set the stage for Bitcoin's explosive journey in 2013. Each transaction, each mined block, and each discussion contributed to a narrative that was as much about redefining money as it was about redefining trust and opportunity. The foundation was set. Now, Bitcoin was ready to soar. On April 1st, 2013, Bitcoin's price hit $100 for the first time. This milestone marked a turning point. Bitcoin was no longer just an obscure digital curiosity. It began its transition into a viable financial asset, captivating enthusiasts worldwide with the promise of a decentralized future. This journey wasn't just about technology. It was about people. Dreamers, developers, and early adopters saw beyond the lines of code. They believed in Bitcoin's potential to redefine money itself. In forums, chat rooms, and meetups, they shared ideas and nurtured innovation. In those early days, Bitcoin's advocates were a diverse group. Libertarians liked the idea of money free from government control. Technologists marveled at the blockchain, the technology behind Bitcoin. Investors, drawn by potential high returns, began to take notice. Gavin Andresen, a software developer, became a key figure in Bitcoin's early adoption. He took on the role of lead maintainer of the Bitcoin codebase. Andresen was crucial in legitimizing Bitcoin within the developer community. In August 2011, he organized the first Bitcoin conference in New York City, attracting hundreds eager to learn more. That event was a watershed moment. For many, it was their first time meeting others who shared their enthusiasm. Ideas flowed freely. Partnerships formed. Seeds of innovation were planted. As Bitcoin's adoption grew, so did its credibility. Media outlets began to cover this new digital currency, bringing it to a wider audience. In 2011, a crucial step toward mainstream acceptance occurred. WikiLeaks began accepting Bitcoin donations after Visa and MasterCard cut them off. This move showcased Bitcoin's potential as an alternative financial network. It demonstrated the resilience of a system independent of conventional banking structures. Throughout 2012, Bitcoin's infrastructure expanded rapidly. New exchanges emerged, making buying and selling easier. Bitstamp and Coinbase, launched in 2011 and 2012, became key players. They provided liquidity and accessibility for Bitcoin's growing user base. Entrepreneurs and investors saw opportunities in this evolving landscape. As 2013 approached, Bitcoin's momentum built. Speculation about its future value fueled demand. On May 2, 2013, Bitcoin hit another record high, surpassing $113. The ongoing European financial crisis and Cyprus's banking turmoil underscored the need for alternative financial instruments. These events drove the price increase. Bitcoin began attracting attention from financial institutions. Mainstream investors showed interest. The idea that Bitcoin could hedge against economic instability gained traction. Venture capitalists and institutional investors explored possibilities within this digital frontier. In the summer of 2013, Bitcoin's rise continued. Its price climbed steadily, capturing headlines. Debates about the future of money sparked. Despite optimism, challenges loomed. Bitcoin's volatility made it a risky investment. Concerns over security, regulation, and scalability tempered excitement. The Mt. Gox exchange emerged as a central pillar. It handled over 70% of global Bitcoin transactions. Founded in 2010 and based in Tokyo, Japan, Mt. Gox provided liquidity and stability. However, technical issues and hacks eroded user trust. Despite vulnerabilities, Bitcoin's allure persisted. Enthusiasts remained undeterred. They believed Bitcoin would transform financial landscapes. Demand surged, pushing prices higher. By November 2013, Bitcoin's value reached unprecedented levels. On November 29, 2013, it peaked at $1,242, momentarily surpassing gold's price. This moment was symbolic. Bitcoin achieved recognition and legitimacy few predicted years earlier. It showcased innovation's power and the promise of a decentralized system. But with success came scrutiny and regulatory attention. One factor in Bitcoin's rise was its acceptance as payment. In 2013, major companies like WordPress and Overstock.com started accepting Bitcoin. This encouraged other retailers to consider digital currency. As more merchants adopted Bitcoin, its utility expanded beyond speculative trading. However, controversy followed Bitcoin's ascent. Critics warned of an asset bubble fueled by speculation. They argued its volatility made it unsuitable as a long-term store of value. Concerns about money laundering and illegal activities cast a shadow over its potential. Bitcoin's popularity brought challenges. Increased demand strained the network. Transaction times lengthened, fees rose. Developers worked to address these issues. Innovation struggled to keep pace with growth. Scalability became a pressing concern. Debates about managing network expansion ensued. Throughout 2013, Bitcoin captivated the world. Financial news outlets analyzed its movements. Economists debated its implications. Ordinary people, tempted by tales of windfall profits, entered the market. Volatility was fueled. Amidst the frenzy, unease lingered. Sustainability questions loomed, as did regulation specters. In December 2013, the Chinese government acted decisively. They banned financial institutions from using Bitcoin. This decision sent shockwaves through the market. Within 4 days, prices dropped 60%. The fragility of investor sentiment and regulatory impact became clear. For many, this period marked a turning point. It underscored risks inherent in a nascent system navigating a complex regulatory landscape. Yet, Bitcoin's core community remained resilient. They continued pushing for innovation, convinced of Bitcoin's transformative potential. Bitcoin's rise in 2013 is a story of ambition and promise. Visionaries challenged the status quo. Investors took risks for new horizons. It reflects a cultural shift towards digitalization. A growing desire for alternatives in an uncertain world emerged. As the year closed, Bitcoin stood at a crossroads. Its future was uncertain, shaped by internal and external forces. Yet, the foundation laid by early adopters remained strong. Their dedication to a decentralized financial system inspired new generations of technologists, entrepreneurs, and dreamers. 2013 left a significant impression. It marked a pivotal moment in digital currency history. A year of transformation, defined by rapid growth and dramatic shifts. Reflecting on this period reminds us of innovation's power and the enduring human spirit. Bitcoin's rise was just the beginning, setting the stage for a new chapter in money's evolution. In the spring of 2013, the world of finance watched with a mix of intrigue and skepticism as Bitcoin's price continued its upward trajectory. April saw its value exceed $100, and in the months that followed, its climb only accelerated. By November 29, 2013, Bitcoin reached a staggering $1,242, surpassing even the price of gold on that day. The meteoric rise of Bitcoin attracted a diverse group of enthusiasts, investors, and opportunists. Young tech-savvy individuals, seasoned investors wary of traditional markets, and libertarians seeking financial autonomy all found a common interest. By mid-2013, the Bitcoin network was processing over 60,000 transactions per day, a tenfold increase from a year earlier. Mining, once a hobbyist activity achievable on a home computer, had industrialized. The introduction of ASIC miners, application-specific integrated circuits, by companies like Butterfly Labs and Avalon, rendered ordinary hardware economically useless almost overnight. Those who had mined thousands of coins on laptops in 2009 and 2010 were sitting on fortunes they had barely imagined. For this generation of early adopters, Bitcoin wasn't just a currency. It was a rebellion. Proof that decentralized systems could rout around the institutions that had failed them in 2008. The allure of Bitcoin in 2013 wasn't solely due to its innovative technology. Global economic conditions played a pivotal role in its surge. The Eurozone crisis was still fresh in the minds of many, with countries like Greece and Spain enduring severe austerity measures. Trust in traditional banking systems had diminished significantly since the 2008 financial meltdown. For investors, Bitcoin represented both a safe haven and a potential gold mine. Yet, behind the exuberant facade of Bitcoin's rise, underlying tensions were brewing. Tensions that would soon come to light. As the cryptocurrency gained mainstream attention, governments and financial institutions began to take notice. Concerns about money laundering, tax evasion, and the potential for illicit activities using Bitcoin started to dominate discussions in financial circles. The United States Treasury's Financial Crimes Enforcement Network, FinCEN, issued guidelines in March 2013, classifying Bitcoin exchanges as money service businesses. This classification meant they were subject to regulations that traditional financial institutions faced, including anti-money laundering (AML) requirements. But while the U.S. attempted to regulate the burgeoning cryptocurrency market, another country was emerging as a key player in Bitcoin's story: China. In late 2013, China accounted for more than half of global Bitcoin transactions. The Chinese public, wary of their own volatile stock market and property bubbles, were drawn to Bitcoin's promise of high returns and financial autonomy. The People's Bank of China initially took a hands-off approach, allowing Bitcoin to flourish within its borders. One of the most influential figures in the Chinese Bitcoin scene was Li Xiaolai, often referred to as China's first Bitcoin billionaire. Li, a former schoolteacher, saw the potential of Bitcoin early on and became one of its most vocal proponents in China. He invested heavily and started sharing his insights through online platforms and seminars, attracting a significant following. For many Chinese investors, Li was a symbol of the new possibilities that Bitcoin represented. However, as Bitcoin continued its ascent, its volatile nature and rapid appreciation raised alarms in Beijing. The Chinese government, known for its stringent control over financial activities, began to scrutinize the cryptocurrency more closely. On December 5, 2013, the People's Bank of China issued a directive banning financial institutions from handling Bitcoin transactions. This move sent shockwaves through the market, causing Bitcoin's price to plummet by 60% in just 4 days. The sudden price drop was a harsh awakening for many investors. Bitcoin fell from over $1,000 to below $600 in 4 days, a 60% drawdown driven entirely by a single government announcement. Panic spread across Bitcoin Talk and Reddit. Trading volume on BTC China, the largest Chinese exchange, collapsed. For those who had entered the market with visions of quick wealth, the reality of Bitcoin's volatility hit hard. Meanwhile, in China, Li Xiaolai faced a different set of challenges. The The government's decision to ban banks from engaging with Bitcoin meant that many of his followers were left without a safe way to trade their holdings. Many Chinese investors who had looked to Li for guidance found themselves in a precarious position. Despite the setback, Li remained optimistic about Bitcoin's future, urging his followers to stay the course. He believed that the Chinese government's actions were a temporary obstacle in the broader journey of cryptocurrencies. Despite the turmoil, some saw opportunity in the chaos. Venture capitalists and tech entrepreneurs viewed the setback not as an end, but as a momentary correction in a much larger trend. In Silicon Valley, investors like Mark Andreessen, co-founder of the venture capital firm Andreessen Horowitz, saw Bitcoin as a transformative technology akin to the internet itself. Andreessen's firm had already made significant investments in Bitcoin-related startups, betting on the long-term potential of both the technology and the economy it might spawn. With the price of Bitcoin falling, public perception began to shift. Media outlets that once heralded Bitcoin as the currency of the future now questioned its viability. Economists and financial analysts debated whether Bitcoin was a bubble destined to burst, leaving ruin in its wake. Among the cacophony of opinions, one thing was clear. Bitcoin had sparked a global conversation about the nature of money, value, and trust. Throughout December 2013, the market remained unstable. Bitcoin's roller coaster year had left a trail of stories, of wealth gained, dreams dashed, and the enduring mystery of digital currency's place in the world. Yet even as its value continued to fluctuate, the core community of developers and enthusiasts remained undeterred. For them, Bitcoin was more than just a price tag. It was an ongoing experiment in creating a new form of money, one that could exist independently of governments and banks. For the early adopters who survived 2013 intact, those who had not kept their coins on Mt. Gox, who had not leveraged their positions, who had held through the 60% drop after China's ban, the turbulence was a costly lesson in market structure rather than a refutation of the technology itself. Many deepened their understanding of the protocol rather than abandoning it. As the year drew to a close, Bitcoin's journey was far from over. It was a story still unfolding, with each chapter contributing to a larger narrative of innovation and disruption. The events of 2013 had laid bare the possibilities and pitfalls of a decentralized currency, challenging the world to reconsider how value was assigned and protected. In the coming years, Bitcoin would continue to evolve, sparking debates and driving change in ways few could have predicted in its early days. The stage was set for the next phase of its tumultuous path. On December 5, 2013, the People's Bank of China made a landmark announcement. They banned all financial institutions from handling Bitcoin transactions. This decision reverberated throughout the global cryptocurrency market, sending shockwaves that would culminate in unforeseen consequences. As the news broke, Bitcoin's price plummeted sharply, a stark contrast to its astonishing rise just days earlier. The ban represented the first major regulatory crackdown on Bitcoin by a national government, signaling the start of a challenging phase for the digital currency. By late 2013, the Chinese market had become a vital component of Bitcoin's ecosystem. Trading volumes in China had surged, driven by a burgeoning interest in cryptocurrencies among Chinese investors. In a nation where capital controls restricted the flow of money across borders, Bitcoin offered a perceived loophole. It was a digital asset that transcended traditional financial barriers. However, the Chinese government's decision to ban banks from engaging with Bitcoin transactions marked a severe blow to this growing market. The immediate impact was a precipitous drop in Bitcoin's value. Within hours of the announcement, Bitcoin's price fell by over 20%, and within days, it had lost nearly 60% of its value, plunging below $500. Investors who had witnessed its meteoric rise just weeks prior found the crash both shocking and devastating. Many had entered the market late, fueled by stories of overnight millionaires and a fear of missing out on what seemed like a financial revolution. The People's Bank of China's decision was rooted in concerns about financial stability and money laundering. Officials feared that Bitcoin's unregulated nature could facilitate illegal activities and disrupt the country's tightly controlled financial system. The ban was a calculated move to curtail the growing influence of cryptocurrencies, which were seen as a threat to the state's monetary policy. In Huobi, one of China's largest cryptocurrency exchanges at the time, panic set in. Traders scrambled to liquidate their holdings, hoping to salvage whatever value remained. The office, usually buzzing with the excitement of fast-paced trading, was filled with tension and uncertainty. Employees worked tirelessly to manage the influx of sell orders, while executives grappled with the long-term implications of the government's decision. For many individuals who had invested their savings into Bitcoin, the crash was a painful experience. Stories emerged of people who had poured their life savings into the digital currency, only to see it evaporate in a matter of days. The allure of quick profits had blinded many to the inherent risks of an unregulated and volatile market. As Bitcoin's value tumbled, so did the dreams and financial stability of countless investors. Outside of China, the impact of the ban was felt across global cryptocurrency exchanges. In the United States, exchanges like Mt. Gox faced unprecedented trading volumes as investors reacted to the news. The crash highlighted the interconnectedness of the global financial system and the vulnerability of Bitcoin to regulatory actions by a single government. In Tokyo, Mt. Gox, once the world's largest Bitcoin exchange, grappled with its own internal challenges. Technical issues and security breaches had already plagued the exchange, eroding trust among its users. The Chinese ban exacerbated these problems as the surge in trading activity overwhelmed the platform's infrastructure. Amidst the chaos, Bitcoin's core community remained steadfast. For early adopters and true believers, this was merely a test of the digital currency's resilience. They viewed the crash as an opportunity to double down on their convictions, convinced that Bitcoin's decentralized nature would ultimately prevail against government intervention. Forums and online communities buzzed with discussions on Bitcoin's future, with some arguing that it was an inevitable step in its journey toward mainstream adoption. The events of late 2013 underscored the precarious balance between innovation and regulation. As governments worldwide began to scrutinize cryptocurrencies more closely, a new narrative emerged. It was a story of tension between state control and the freedoms offered by decentralized technology. In the months that followed, other countries would take note of China's actions, leading to a patchwork of regulations across the globe. For investors, the crash served as a harsh reminder of the volatility inherent in emerging markets. Some, having lost significant amounts of money, swore off Bitcoin altogether, viewing it as a reckless gamble rather than a legitimate investment. Others, however, saw potential in its underlying technology, recognizing its capacity to disrupt traditional financial systems. In Shenzhen, a tech hub known for its innovative spirit, entrepreneurs quietly began exploring blockchain applications beyond just currency. The crash had sparked a reassessment of Bitcoin's role, leading to a proliferation of projects that sought to harness blockchain technology for diverse uses. This pivot marked the beginning of a broader movement, one that would eventually lead to the development of smart contracts and decentralized applications. Meanwhile, Bitcoin's founder, Satoshi Nakamoto, remained out of sight. Despite the turmoil and debate surrounding his creation, he continued to stay out of the public eye. Speculation about his identity persisted, with theories ranging from a single genius coder to a group of developers operating under a shared pseudonym. The mystery only added to the allure of Bitcoin, fueling intrigue and debate among academics and enthusiasts alike. As 2013 drew to a close, the cryptocurrency market appeared bruised but not broken. While Bitcoin's value had plummeted, its influence persisted. The events of that year had thrust it into the global spotlight, drawing attention from media, investors, and regulators worldwide. The volatility and uncertainty underscored the nascent nature of digital currencies, highlighting both their potential and their peril. In the following months, the cryptocurrency community began to rebuild, learning from the mistakes and triumphs of the past. There was a renewed emphasis on security and transparency, as exchanges implemented stricter measures to protect users from hacks and fraud. The lessons of 2013 served as a foundation for future developments in the space, guiding the next wave of innovation in blockchain technology. The Chinese ban on Bitcoin transactions marked a turning point in the cryptocurrency's journey. It was a sobering moment, one that forced investors, developers, and policymakers to confront the complexities of this emerging technology. As they navigated the aftermath, a new chapter in the story of Bitcoin was about to unfold, shaped by the challenges and opportunities unveiled during a pivotal year. In December 2013, Bitcoin's value plummeted sharply. Just a week earlier, it had hit $1,242. Now, prices tumbled below $700. The market was in turmoil. China's ban on Bitcoin transactions wasn't the only cause of the crash. Speculative trading had pushed the bubble to its limit. Investors caught in the frenzy rushed to sell. Panic spread across forums and trading platforms. Amid this chaos, Mt. Gox, the largest Bitcoin exchange, struggled. Founded in 2010 by Jed McCaleb and later sold to Mark Karpelès, the Tokyo-based exchange was central to Bitcoin trading, but it faced technical issues and security problems. On December 17, 2013, Mt. Gox suspended US dollar withdrawals. This decision further shook the fragile market. Users reported account delays and discrepancies. Rumors of insolvency began circulating. Mark Karpelès, the French entrepreneur leading Mt. Gox, was under intense scrutiny. Questions about the exchange's operations grew louder. Karpelès, known for his reclusive nature, rarely appeared publicly. His silence increased investor unease. The cracks in the Bitcoin market weren't just technical, they were deeply human. Behind the numbers lay questions that could not be answered by charts or code. Hold on and risk total loss, or sell and crystallize a gain before it evaporated. The market offered no signal, only noise. Posts on Reddit's r/Bitcoin and Bitcoin Talk forums swung between defiant conviction and naked panic within the space of hours. The crash took a significant emotional toll. Investors felt loss and regret. Online forums were filled with stories of total financial ruin. Sleepless nights and strained relationships were common. Many sought support in these online communities. Yet not everyone lost hope. Long-term believers, or hodlers, stood firm. They saw the crash as a painful, necessary correction. For them, Bitcoin's technology and philosophy were still sound. They would endure the storm for future gains. The market's volatility also attracted new participants. Opportunistic traders saw falling prices as a buying opportunity. Financial analysts debated Bitcoin's future. Would it stabilize, or were further declines coming? Opinions were divided. Meanwhile, global regulatory bodies watched closely. In the U.S., the Securities and Exchange Commission increased scrutiny on Bitcoin exchanges. Concerns about fraud and money laundering led to discussions of regulation. How to regulate a decentralized currency was complex and unprecedented. By December's end, Bitcoin hovered around $750, less than two-thirds of its peak. The new year brought reflection and recalibration. Investors reconsidered strategies, and enthusiasts rethought their roles. 2013 left a lasting impact on the cryptocurrency community. The crash highlighted risks inherent in an unregulated, speculative market. It underscored the need for transparency and security in exchanges. The focus now shifted to building better infrastructure and fostering trust. Lessons from 2013 would shape Bitcoin's future. In January 2014, enthusiasts met in Miami for the North American Bitcoin Conference. The atmosphere was somber yet determined. Speakers addressed the past year's challenges, emphasizing resilience and innovation. Attendees left with renewed purpose, aiming for a sustainable future. Back in Tokyo, Mt. Gox quietly worked to resolve its issues, but the situation was dire. Internal documents showed hundreds of thousands of bitcoins lost, valued at millions, due to hacking and mismanagement. This remained hidden, fueling speculation and distrust. By February, Mt. Gox's troubles were undeniable. On February 7, 2014, the exchange halted all withdrawals, citing technical difficulties. The news sent shockwaves through the market. Bitcoin's price dropped further. Confidence in Mt. Gox vanished. Communication was sparse and unhelpful. On February 24th, Mt. Gox filed for bankruptcy protection in Japan. Mark Karpeles admitted approximately 850,000 bitcoins were unaccounted for. This staggering sum represented about 6% of all bitcoins. The revelation was devastating, impacting Bitcoin's reputation severely. The fallout from Mt. Gox's collapse was profound. Trust in cryptocurrency exchanges was heavily damaged. Investors reeled and questioned Bitcoin's future. The incident underscored the urgent need for security and regulation in the industry. For those affected, the impact was long-lasting. Many investors lost significant sums. Some would never recover their funds. Lawsuits were filed against Mt. Gox and its executives. The legal battles would continue for years, a reminder of early cryptocurrency volatility. Amidst the turmoil, innovation persisted. New exchanges emerged, learning from past mistakes. They implemented stricter security measures and transparency protocols. The community rallied around decentralization, focusing on decentralized exchanges to mitigate centralized platform risks. As the year progressed, the Bitcoin community began to heal. The narrative shifted from loss to resilience and renewal. Developers continued improving the Bitcoin protocol, addressing scalability and security. Investors returned cautiously, drawn by blockchain's transformative potential. By late 2014, Bitcoin's price stabilized around $400. It was far from previous highs, but stability returned. The lessons of 2013 and its aftermath served as a sobering reminder of the technology's risks and rewards. Those who lived through the crash informed future cryptocurrency developments. The community carried scars of past failures and hopes for future success. Bitcoin's story was far from over. New chapters awaited, shaped by the lessons learned during this transformative period. In the months following December 2013, Bitcoin's roller coaster trajectory inflicted a deep sense of unease within the cryptocurrency community. By early 2014, the price fluctuated wildly between $400 and $500, a stark decline from its zenith just months prior. Investors, once emboldened by dreams of boundless wealth, now faced harsh reality. Many had entered the market at its peak, chasing what they believed was an unstoppable ascent. However, the downturn shattered these illusions, leaving a trail of financial ruin and disillusionment. January 2014 marked a critical moment for those who had invested heavily. Bitcoin had peaked at $1,242 on November 29, 2013, the single highest close in that bull cycle. By mid-January, it had already fallen to $900. By February, it was below $600. Those who had entered near the peak found their positions halved in weeks, their confidence in the technology shaken alongside their account balances. The psychological toll compounded the financial one. Online forums that had once buzzed with celebration now filled with fear, recrimination, and desperate calculations about break-even prices. The psychological toll on investors was palpable. Financial losses were compounded by a pervasive sense of betrayal. Bitcoin, once heralded as a beacon of hope against traditional financial systems, now seemed perilously unstable. The cryptocurrency community, previously united in their vision of decentralization, began to fracture. Divisions emerged between those who advocated for holding steadfast in the face of adversity and those who sought to cut their losses before the market eroded further. In the midst of this turmoil, a significant event threatened to destabilize the fragile ecosystem even further. February 2014 saw the collapse of Mt. Gox, the largest Bitcoin exchange at the time. Based in Tokyo, Mt. Gox handled approximately 70% of all Bitcoin transactions worldwide. On February 24th, an announcement stunned the cryptocurrency world. Mt. Gox had suspended all trading, citing security concerns. The exchange soon declared bankruptcy, disclosing that nearly 850,000 bitcoins, valued at over $450 million, had vanished due to a combination of theft and mismanagement. The fallout from Mt. Gox's implosion was profound. Trust in online exchanges, critical for Bitcoin's functioning, was severely undermined. Investors, already reeling from price declines, now faced the chilling reality that their assets could disappear overnight. Law enforcement agencies worldwide launched investigations, yet the complexities of digital currencies posed significant challenges. Traditional financial systems had protocols for theft and fraud, but Bitcoin's decentralized nature meant there was no central authority to appeal to or regulate the space. Amidst this chaos, the human toll was staggering. Mt. Gox's bankruptcy filing in February 2014 listed liabilities of approximately 6.5 billion yen, roughly $64 million at the time. Behind those figures were hundreds of thousands of individual accounts, each representing a person who had placed their trust in a platform they believed was too central to fail. The coins were gone. There was no deposit insurance, no government backstop, no recourse. Yet not all were disheartened. A segment of the community, comprised of developers, technologists, and true believers in the potential of blockchain, remained steadfast. To them, the Mt. Gox incident was a harsh but necessary lesson in the vulnerabilities of centralized exchanges. They argued that the fault lay not with Bitcoin itself, but with the flawed infrastructures built around it. This perspective fostered a renewed commitment to enhancing security protocols and developing decentralized alternatives that would safeguard against future catastrophes. As 2014 unfolded, regulatory bodies across the globe began to take notice. The collapse of Mt. Gox served as a wake-up call, prompting discussions around the need for clearer guidelines and oversight. Policymakers debated how best to protect consumers without stifling innovation. In the United States, the New York State Department of Financial Services initiated a process to develop a regulatory framework for cryptocurrencies, eventually leading to the introduction of the BIT license in 2015. This regulatory initiative was met with mixed reactions. Some viewed it as a necessary step toward legitimacy, while others feared it might stifle the very innovation that had given rise to Bitcoin. The tension between regulation and freedom would continue to shape the discourse around cryptocurrencies for years to come. Despite the turbulence, the underlying technology of Bitcoin, blockchain, continued to attract interest and investment. Tech giants and financial institutions began exploring its potential applications beyond currency, from supply chain management to secure voting systems. The resilience of the Bitcoin network itself, unharmed by the exchange failures, underscored the robustness of Nakamoto's original design. Developers around the world continued to contribute to the open-source project, ensuring its evolution and adaptation to new challenges. By late 2014, Bitcoin's price began to stabilize, hovering consistently around $400. For many investors, this represented a degree of relief, a stabilization after a year marked by volatility and uncertainty. While the exuberance of 2013 felt distant, a cautious optimism started to re-emerge. Conferences and meetups, once dominated by discussions of price speculation, shifted focus to technological innovation and regulatory developments. The community, though scarred by the events of the past year, began to coalesce around a renewed vision for the future of digital currencies. For some, the 2013 crash and subsequent recovery efforts served as a testament to Bitcoin's resilience. It had weathered one of the most challenging periods in its short history, and despite significant setbacks, had not only survived, but found ways to adapt and grow. The lessons learned during this turbulent time would inform decisions and strategies in the years to come, as the cryptocurrency landscape continued to evolve. Developers, investors, and regulators alike had gained invaluable insights into the complexities and potential of digital currencies. As 2014 drew to a close, the community stood at a crossroads. The events of the past year had demonstrated both the risks and rewards inherent in this nascent technology. Many remained committed to the vision of a decentralized financial future, undeterred by the setbacks. The story of Bitcoin in 2013 was one of dramatic rise and fall, marked by dreams, losses, and resilience. It was a year that tested the very fabric of the cryptocurrency world, highlighting vulnerabilities, but also illuminating paths forward. In the end, this period would be remembered not only for the financial turmoil, but for the hard-earned wisdom it imparted to those who dared to venture into this brave new world. The journey was far from over, and the lessons learned would serve as a foundation for the challenges and triumphs that lay ahead. In early 2014, the cryptocurrency community found itself in a cautious reflection following the upheaval of the previous year. The fallout from Bitcoin's dramatic roller coaster had left investors and enthusiasts grappling with a new landscape that was both uncertain and educational. For many, the dizzying highs and crushing lows of Bitcoin's value had underscored the volatility inherent in this digital frontier. Regulators worldwide began to scrutinize the cryptocurrency space more closely as calls for oversight grew louder. In the United States, the Securities and Exchange Commission, SEC, started to examine the implications of this nascent market. Their focus centered on investor protection and the potential for illegal activities such as money laundering to thrive under the cloak of anonymity offered by Bitcoin. Simultaneously, countries like Japan and South Korea explored frameworks to regulate and integrate digital currencies into their financial systems. Meanwhile, in New York, Benjamin Lawsky, the superintendent of financial services, announced the creation of a regulatory roadmap for cryptocurrencies. This initiative aimed to strike a balance between innovation and consumer protection, acknowledging the transformative potential of blockchain technology while mitigating its risks. This regulatory shift marked a pivotal moment as governments began to recognize cryptocurrencies' legitimacy and their broader impact on the financial landscape. However, the road to recovery was not straightforward for those who had invested heavily in Bitcoin at its peak. Many had bought into the promise of astronomical returns, only to watch their investments crumble as Bitcoin's price plunged from its all-time high of $1,242. In hindsight, it was clear that the speculative frenzy had obscured the fundamental principles that Bitcoin's creator, Satoshi Nakamoto, had envisioned: a decentralized, peer-to-peer system that could operate outside traditional financial structures. The impact of the crash extended beyond individual losses. It prompted a re-evaluation of the cryptocurrency ecosystem itself. The need for robust security measures became apparent after several high-profile exchange hacks exposed vulnerabilities in the technical infrastructure supporting Bitcoin trading. Mt. Gox, once the largest Bitcoin exchange, filed for bankruptcy in February 2014, following a loss of approximately 850,000 Bitcoins, valued at about $450 million at the time. This incident served as a stark reminder of the risks associated with the nascent market. Amidst this tumult, the Bitcoin community demonstrated remarkable resilience. Developers and enthusiasts doubled down on efforts to strengthen the network's security and promote wider adoption. New platforms and exchanges emerged with enhanced security protocols designed to restore trust and stability. Amidst the chaos, a dedicated group of technologists continued to refine the underlying blockchain technology, exploring its potential applications beyond digital currency. The aftermath of the crash also sparked a broader conversation about the societal implications of cryptocurrencies. Advocates argued that Bitcoin and other digital currencies could empower individuals by providing financial access to those excluded from traditional banking systems. Critics, however, cautioned that the anonymity of transactions could facilitate illicit activities and bypass regulatory oversight. This dichotomy illustrated the broader tension between innovation and regulation that would characterize the ongoing evolution of the cryptocurrency market. In 2015, the narrative began to shift again as Bitcoin's price showed signs of a slow but steady recovery. This gradual upward trend was driven by a renewed interest in blockchain technology, which many industries began to explore for its potential to revolutionize operations. Companies across sectors such as finance, supply chain, and healthcare started pilot projects to integrate blockchain solutions, recognizing its capacity to increase transparency and efficiency. At the same time, initiatives like the Bitcoin Foundation work to foster better understanding and education about cryptocurrencies. They aim to demystify the technology for the public and policymakers, emphasizing its potential for positive change while addressing common misconceptions. This educational push was crucial in promoting a more informed dialogue about the future of digital currencies and their role in the global economy. For individual investors, the lessons from the 2013 bubble were profound. Many who had experienced substantial losses used this period to reassess their investment strategies and risk tolerance. The experience highlighted the importance of due diligence and a long-term perspective when navigating the volatile world of cryptocurrencies. This newfound caution contributed to a more measured approach to investing, as individuals recognized the speculative nature of the market. By the end of 2016, Bitcoin's price had surpassed $1,000 once more, signaling a renewed confidence in the cryptocurrency's potential. This recovery phase was marked by a more informed investor base and the emergence of new digital currencies that diversified the cryptocurrency market. Ethereum, launched in 2015 by Vitalik Buterin, introduced smart contracts, expanding the possibilities for blockchain technology beyond simple transactions. As the market matured, Bitcoin solidified its position as the flagship cryptocurrency. Its resilience in the face of adversity had earned it a reputation as a digital store of value, akin to gold in the traditional financial world. This perception was bolstered by growing adoption among institutional investors who saw Bitcoin as a hedge against economic uncertainty and currency devaluation. The story of Bitcoin's recovery was not just one of price resurgence, but of the broader recognition and integration of cryptocurrencies into mainstream financial systems. By 2017, major financial institutions began to offer Bitcoin futures contracts, further legitimizing its presence in the financial markets. This institutional interest played a crucial role in driving Bitcoin's value to new heights, surpassing $19,000 by the end of the year. Looking back, the aftermath of the 2013 Bitcoin bubble had reshaped the cryptocurrency landscape in profound ways. It had spurred a movement towards increased regulation, improved security, and broader acceptance of digital currencies. The lessons learned during this period served as a foundation for the challenges and innovations that lay ahead, marking a critical chapter in the ongoing evolution of the cryptocurrency industry. In the years following, Bitcoin's journey would continue to be defined by both triumphs and trials. As the world leaned into the potential of blockchain technology, the dialogue surrounding cryptocurrencies evolved, embracing both skepticism and optimism in equal measure. The stakes were high, and as the story unfolded, it was clear that Bitcoin's impact would ripple far beyond its digital origins, influencing the future of finance and technology alike. On January 25, 2014, a troubling email emerged from Mt. Gox, the largest Bitcoin exchange at the time, warning its users of technical issues. The Tokyo-based platform, once the epicenter of Bitcoin trading, had faced increasingly frequent operational challenges. Users reported consistent delays in withdrawals, with transactions that should have been instantaneous taking days or even weeks to process. The escalation of these issues drew the attention of regulators and investors alike, prompting an investigation into the exchange's operations. Mt. Gox, founded in 2010 by programmer Jed McCaleb, had quickly grown to handle over 70% of all Bitcoin transactions worldwide by 2013. Its meteoric rise mirrored Bitcoin's own ascent, a testament to the cryptocurrency's allure and potential. However, in the world of finance, rapid growth often invites scrutiny. In February 2014, the situation at Mt. Gox deteriorated further. Users were unable to withdraw funds, and rumors of insolvency began circulating with whispers of a massive security breach. By February 7th, Mt. Gox had suspended all Bitcoin withdrawals, citing a technical issue they referred to as transaction malleability, a vulnerability within the Bitcoin protocol. This announcement rocked the cryptocurrency community, casting a shadow of doubt over the integrity of Bitcoin exchanges. Transaction malleability allowed for the manipulation of transaction IDs, though it was a known issue within the system. In theory, it could be exploited to make it appear that a transaction had not occurred even after it had been processed. Critics argued that Mt. Gox had used this vulnerability as a scapegoat for deeper issues within their own infrastructure. Amidst the upheaval, Mark Karpeles, the CEO of Mt. Gox, became the face of the crisis. A French expatriate living in Japan, Karpeles was thrust into the spotlight. His demeanor during public appearances did little to reassure investors, often appearing evasive and overwhelmed. The pressures of leadership under such scrutiny were immense, and the stakes were nothing short of existential for the exchange. As Mt. Gox's troubles became a matter of international concern, regulators in Japan initiated an investigation. Their aim was to discern whether the company had engaged in fraudulent activities or if it was beset by mismanagement. Financial oversight bodies, wary of the burgeoning cryptocurrency ecosystem, viewed Mt. Gox's collapse as a cautionary example of unregulated markets. By February 24th, the situation at Mt. Gox reached a critical point. The company abruptly halted all trading and the website went offline, signaling a total collapse. A leaked document, purportedly detailing its financial woes, suggested that over 850,000 bitcoins were missing, a staggering amount valued at approximately $450 million at the time. This revelation sent shockwaves throughout the financial world. Investors whose portfolios had become intertwined with Bitcoin's fortunes faced potentially catastrophic losses. The disappearance of such a substantial sum highlighted the vulnerabilities inherent in digital currencies. The allure of decentralization came with the peril of security breaches. As the investigation unfolded, attention turned to the blockchain, Bitcoin's public ledger. It was a transparent yet complex record of every transaction ever made within the network. Analysts pored over the data, seeking patterns or irregularities that might explain the missing assets. The blockchain, in its immutable nature, offered clues yet also posed challenges due to its sheer volume and intricacy. Meanwhile, the human element of the story proved equally compelling. Countless individuals, ranging from tech-savvy enthusiasts to everyday people hoping to get in on the next big financial innovation, found themselves affected. Stories emerged of life savings wiped out, dreams of financial independence dashed overnight. The emotional toll was profound, with many grappling with the realization that their digital assets could vanish with the click of a button. In the aftermath of Mt. Gox's collapse, the cryptocurrency community faced a crossroads. Questions of accountability, oversight, and the future of digital currencies dominated discussions. Conferences and forums became arenas for debates on how to prevent similar incidents in the future, with voices advocating for stronger regulatory frameworks. Simultaneously, Bitcoin's decentralized ethos was both praised and critiqued. Supporters argued it was precisely this lack of centralized control that had allowed Bitcoin to thrive, free from government intervention. Critics, however, pointed to the Mt. Gox debacle as evidence that some form of regulation was necessary to protect investors. As investigators continued their work, Karpeles faced mounting legal challenges. Allegations of embezzlement and data manipulation emerged, further complicating the legal landscape. The international nature of Bitcoin trading added layers of complexity to these proceedings, with courts in Japan and abroad struggling to navigate uncharted legal territory. By the end of 2014, the investigation had uncovered a partial answer to the mystery of the missing Bitcoins. It seemed that much of the loss could be attributed to years of unnoticed theft, exacerbated by poor management and security practices at Mt. Gox. While some funds were eventually recovered, the incident underscored the need for more robust security measures in the nascent cryptocurrency industry. The ramifications of the Mt. Gox investigation were far-reaching. For regulators, it served as a stark reminder of the challenges posed by rapidly evolving financial technologies. For the cryptocurrency community, it ignited a renewed focus on security protocols, with exchanges worldwide implementing more stringent measures to safeguard assets. Despite these efforts, the loss of public trust proved difficult to regain. Bitcoin's value continued to fluctuate, reflecting the uncertainty that now permeated the market. Investors, once emboldened by the promise of untold wealth, approached the market with caution, tempered by the lessons of past missteps. Yet, amidst the turmoil, Bitcoin endured. The very nature of its decentralized framework meant that no single entity could bring it to its knees. This resilience, born from its global network of users and miners, became both its greatest strength and a beacon of hope for those who still believed in its potential to reshape the financial landscape. As 2015 dawned, the echoes of Mt. Gox's collapse continued to resonate within the cryptocurrency sphere. The lessons learned during this turbulent chapter served as a catalyst for change, driving innovations in technology and governance. In the years that followed, Bitcoin would face new challenges and opportunities, its evolution marked by the indelible experiences of 2013 and 2014. As the investigation concluded, one truth remained. The path to reimagining finance was fraught with obstacles, yet ripe with potential. By January 2014, the cryptocurrency community awoke to a sobering reality. The allure of rapid wealth had given way to the stark unpredictability of this digital frontier. With investigations into the Mt. Gox debacle still unfolding, the industry faced a crucial juncture. The pressing question was, what legacy would Bitcoin's tumultuous 2013 leave behind? The fallout from the Mt. Gox collapse led to multiple lawsuits and a global outcry. Investors watched helplessly as their digital assets vanished into the ether. This event underscored the urgent need for stronger safeguards and clearer regulations within the cryptocurrency ecosystem. Trust and transparency, often assumed but rarely confirmed, were essential. In February 2014, Mt. Gox filed for bankruptcy protection in Tokyo. It admitted that approximately 850,000 bitcoins, worth over $450 million, had disappeared. The news sent shockwaves throughout the financial world. Fear over digital currency security intensified. Confidence in Bitcoin and similar ventures was severely shaken, highlighting the risks of unregulated markets. The Mt. Gox incident became a catalyst for change. It prompted broader discussions about regulatory frameworks tailored for cryptocurrencies. Governments worldwide began considering measures to protect investors while fostering innovation. The events of 2013 and early 2014 highlighted the need for balance between oversight and freedom, a debate that continues today. Despite controversies, Bitcoin's core principles, decentralization, transparency, and limited supply, remained intact. These ideals inspired a new wave of digital entrepreneurs. Many saw potential in blockchain technology beyond currency, envisioning applications in supply chain, healthcare, and voting systems. This marked a shift from speculation on future wealth to harnessing technology for tangible benefits. After the crash, exchanges and wallet services adopted more stringent security measures. Cold storage, multi-signature wallets, and improved encryption became standard practice. These adjustments reflected a growing understanding of digital asset vulnerabilities. Protection from both internal errors and external threats was necessary. Educating the public became a priority. Initiatives aimed at increasing awareness about cryptocurrency risks and benefits proliferated. Workshops, online courses, and community meetups emerged, fostering informed participation. The aim was to equip individuals with the knowledge needed to navigate this volatile landscape safely and responsibly. By 2015, Bitcoin started regaining some lost value, though far from late 2013's heights. This recovery was gradual, suggesting a more cautious market. Investors, having learned from past excesses, approached the market with tempered expectations. The roller coaster of 2013 served as a reminder of the speculative nature of such investments. A more balanced approach to risk-taking emerged. Bitcoin's legacy extends beyond price fluctuations. It sparked a cultural shift towards questioning traditional financial systems and exploring alternatives. For many, Bitcoin symbolized a departure from reliance on centralized authorities, a step towards individual empowerment. This stance resonated deeply during times of economic uncertainty and technological transformation. In parallel with Bitcoin's evolving role, other cryptocurrencies emerged. Each sought to address specific limitations or expand on the original concept. Ethereum, launched in 2015, introduced smart contracts, self-executing agreements automating processes across the blockchain. These innovations demonstrated digital currencies' flexibility and capacity to foster new industries. Lessons from 2013 encouraged cross-sector collaboration. Financial institutions, once skeptical, began exploring blockchain applications for efficiency and transparency. This interest signaled a growing recognition of the technology's potential to transform transactions. It suggested a future where traditional finance and digital currencies could coalesce instead of conflict. Yet, as Bitcoin and its counterparts gained traction, the regulatory landscape remained complex. Countries like Japan took proactive steps, recognizing Bitcoin as legal tender by mid-2017. This move reflected an openness to innovation, tempered by a commitment to safeguard citizens' investments. Other nations imposed strict regulations or outright bans, highlighting ongoing tension between control and freedom in the digital age. Bitcoin's journey has been one of resilience and reinvention. It has weathered skepticism, scandal, and market sentiment shifts. Each challenge prompted introspection and adaptation within the community, forging a path toward greater legitimacy. Despite setbacks, Bitcoin's foundational technology continues to inspire confidence and creativity. The legacy of Bitcoin's rise and fall during the early 2010s is multifaceted. It serves as a testament to ideas, power, and the complexities of implementing them globally. It illustrates the fragile balance between innovation and oversight, rewards and risks. As Bitcoin evolves, it remains emblematic of both the promise and peril of pioneering new economic frontiers. Ultimately, Bitcoin's narrative cannot be confined to peaks and valleys. Its significance lies in the ongoing dialogue it provokes about the future of money, trust, and autonomy. The events of 2013 act as a historical touchstone, reminders of nascent technology's volatility and vigor. They underscore the importance of caution and curiosity as society grapples with digital transformation implications. Bitcoin's story is far from over. It unfolds continuously, shaped by those who engage with it. As we move forward, lessons from its past provide invaluable guidance. They remind us that while technology can revolutionize industries, the human element ultimately determines its impact. The legacy of Bitcoin's early years is woven into modern finance's fabric. It guides ongoing discussions around innovation, regulation, and ethics in the digital age. It challenges us to reconsider currency values and commerce's future. This evolving narrative beckons us to participate, question, and imagine what lies beyond the horizon. As the digital landscape shifts, Bitcoin's legacy will likely inspire future generations. Its journey from obscurity to financial discourse's forefront embodies disruptive innovation's essence. The story of Bitcoin's rise and fall, its challenges and triumphs, will echo through history. It will remind us of innovation's enduring power and the indomitable spirit of those who dare to dream. In the dim light of early 2014, a somber reality settled over Tokyo. Mt. Gox, the world's largest Bitcoin exchange at the time, stood as a silent monument to the tumult of the previous year. Its neon signs flickered against the night sky, casting long shadows over bustling Shibuya. Inside, the echoes of frantic trading, once feverish with hope and promise, had quieted to a distant murmur. The story of Bitcoin in 2013 is etched in the memories of those who lived through its dizzying heights and crushing lows. Early adopters saw more than just a string of numbers. They envisioned a future unbound by traditional financial institutions. They gathered in online forums, discussing cryptographic puzzles and decentralized networks, their digital conversations forming the backbone of this nascent currency. Bitcoin's value soared to $1,242 on November 29, 2013, surpassing even the price of gold. Investors poured in, their eyes fixed on the charts that climbed ever higher. But with each peak came the inevitable descent, a reminder of the volatility that lay beneath Bitcoin's digital veneer. The People's Bank of China's decision to ban banks from handling Bitcoin transactions on December 5, 2013, shifted the ground beneath this digital currency. The global reverberations were immediate and profound. Prices plummeted, falling below $700 within days, as panic rippled through the ranks of investors. Those who had seen Bitcoin as a path to untold riches now found themselves grappling with uncertainty and loss. Amidst the turmoil, the lessons of 2013 began to crystallize. The frenzy of growth and subsequent crash underscored the need for caution in the face of emerging technologies. Bitcoin's trajectory reminded the world of the age-old dance between innovation and regulation. It was a lesson not just for the cryptocurrency community, but for anyone who dared to balance the allure of discovery with the necessity of prudence. By early 2014, as the dust settled, a new chapter began to unfold. Investors and enthusiasts reflected on their experiences, their reflections colored by the red ink of financial loss, but also by the clarity born of experience. In the quiet aftermath, discussions turned toward the future. How to build a more resilient system, one less prone to the whims of speculation and more grounded in solid technological foundations. In this landscape, Mt. Gox stood as both a cautionary story and a beacon for the future. Its story served as a reminder of the fragility of trust and the critical role of transparency in financial systems. As investigations unfolded, seeking to unravel the threads of what had gone wrong, the world watched closely, eager to glean insights that might guide the next steps. As you drift off to sleep, let the image of Mt. Gox's silent facade linger in your mind. Picture the bustling streets of Shibuya, where life goes on amid the echoes of a digital revolution. Imagine the early mornings in Tokyo, where the first light breaks over the skyline, casting a gentle glow on a city that never truly sleeps. Let your thoughts settle into the rhythm of the night, each breath a reminder of the resilience of human ambition. Allow yourself to rest, knowing that even in the face of uncertainty, we continue to learn, adapt, and dream of what might come next.